what's common that people should always remember if they hear this as an investor is that how you created your wealth and the skills you have, your distribution network, maybe your position in an industry, your relationships, that you created your wealth for some very specific reasons, and you can continue to create more wealth. And sometimes the best defense is having a good offense, because you can be diversified. When the whole market goes down, you might go down with it. But the people who have a good offensive game can not only be smart enough to allocate after things have gone down, but also be making money even while the general industry or economy is going down.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Richard Wilson operates the largest ultra-wealthy investor club, the Family Office Club, as well as commercialrealestate.com and billionaires.com. He has set up over 100 family offices for clients and hosted 150 plus live investment club events. Richard, welcome to the show.
Thanks for having me here, Sam. Appreciate it.
The pleasure's mine. The same three questions I ask every guest who comes on the show. Can you very quickly tell us, where did you start? Where are you now? And how did you get there?
Sure. Yeah. So I started in 2007. I was raising capital and figured out there's a thing called family offices. So I started writing on a blog, and I wrote a book for Wiley. We bought familyoffices.com, and then just listened to our clients over the last 14 years. I've spoken a couple hundred times in 15 countries, and then we've hosted now 150 of our own conferences. And I've written 13 books in the last 14 years and just learned a lot through hosting all those events and interviewing a lot of ultra wealthy families and setting up about 100 ultra wealthy family office wealth solutions for clients. Putting together their family offices essentially. And so where we're going now is really building our platform. So we have a community called Family Office Club, and we offer 15 to 20 live events per year, an online platform with investor mandates recorded in there. And we get smarter for people raising capital and do workshops for them and have helpful investor summits for people raising capital, because we're always doing text messages, phone calls, and emails, closing deals with our investors. And because we're working with the capital raisers, we have really good deal flow to show to our investors. And so out of 1,000 people who pay for a membership in the Family Office Club, 10 or 20 of them are really interesting to some of our top investor clients, and they appreciate access to that flow. And it's because of our Family Office Club platform at familyoffices.com, but also because of commercialrealestate.com and billionaires.com that we have really high volume deal flow, which allows us to kind of see the forest a bit.
That is fascinating. I want to hear more of this story. How did you really grow? Yes, posting on blogs, things like that, but grow the idea that this was a niche and then there was a problem you can solve. And I guess the backup question to that is, what was the problem that you ended up finding out across the board that needed to be solved?
Yeah, so two stages of that. The first problem was that when raising capital for some things like a hedge fund, you want to go to accredited investors at the very least, and it'd be better if you could raise 7-figure checks per investor. So when I figured out that was an issue, I said, okay, who has all of the ultra wealthy clients, or where are they? And I figured out some of them were calling themselves family offices, which has nothing to do with having an office in the basement of your family's house. It's just an ultra wealthy wealth solution. But back in 2007, almost no one knew what the word meant. We got in the industry really early, wrote some of the first books on the space, et cetera. And so part of the issue was spreading the word about the industry. And part of it was, how do I talk to these people, because they're private and nobody's really talking about them. So we provided one of the first websites and educational resources and YouTube channels and podcasts on family offices. And that grew our stance in the industry, and also allowed us to solve the problem of how do we go direct to the people with all of the money. The joke says, why'd you rob the bank? And it's like, well, that's where all the money was, right? So it's kind of trying to figure out, how do you work with family offices? So 14 years later, I've seen that the other problem is that a lot of these families are not sure who to trust after they get liquid. They don't know what a family office is or if they need one. They don't know how to set one up. They don't speak to too many of their peers. And there's just a big gap between when people start a family office and make a whole bunch of $1 million mistakes versus those who have ran family offices for 5 or 10 years, know of certain best practices everyone should be doing. And many people learn those the hard way. So those are the two gaps we kind of fill.
Yeah. And on that note of, probably, not secrecy, but, these aren't people that are advertising or waving flags saying, hey, by the way, we just had a business sell, we just had something happen and now we're super liquid. I mean, how do you find these families that are in need of what you guys do? And at this point, you've probably got some momentum, but early on, how'd you find them?
I was at Orange Theory yesterday working out, and they play like some hip hop type music. And one of the lines I heard when I was on the treadmill was like, "Oh, I don't chase money; money chases me." And I don't know who's saying that, but like I heard that, and I was like, that is the key to our investor funnel and our platform, is that it's not that all the family offices are chasing us, but we reverse the flow. Like we don't cold call family offices or cold email these groups. We position ourselves to be found when they have a migraine. We want to be a form of Excedrin for that headache. So it could be when they search, how do I start a family office? And they find our book called How to Start a Family Office. It could be them researching what other centimillionaires are doing, which means 100 million net worth. And we have the only book written for centimillionaires. And so we have resources and articles and blog posts and interviews and podcasts like this that are very helpful to some ultra wealthy families. And when we can add value to them on a podcast they listen to for free, then the son of the $100 million net worth person emails their dad and says, "Hey, we should get on a call with Richard to formalize our family office, etc." Because he just rattled off a whole bunch of things that we should be doing as a family, and we're not doing them. And we need some help and guidance here. So it's all about adding value first, because these individuals, even if you had a big team to reach out to all of them cold, they're very busy, and they would rather reach out to someone at a time when they need their help as a resource rather than answer a voicemail or a random email from someone they don't know.
Right. Yeah, absolutely. When you guys first onboard a family office, what are some of the common problems that you are helping them solve?
Yeah, there's so many big expensive ones. I'll rattle them off like real quick, so that's not too long-winded. One is a lot of them to start investing all over the place in a bunch of startups and really risky angel investments. Big mistake. A lot of them don't study their own DNA, passion, where they want to go in the future, what's going to be in growing demand, what's not too competitive, and zero in their strike zone based on where they made their money or what skill sets they have as a family. And if they went through that process, then they could focus their energy on playing offense within the stem cell industry or manufacturing or self-storage, wherever they want to play offense, and then diversify into cash flowing real estate, maybe some real estate development, and then figure out who the best virtual family office or multifamily office manager could be for their public portfolio, unless they made their money in the public markets. And many don't go through that process. And many don't identify what their values and objectives are. And they start hiring people and spending money on consultants and putting money into deals, and they haven't yet even put down on paper on one page exactly who they are, what they stand for. And once you do that, you can hire and fire and spend money with more conviction and invest your money in your portfolio with more conviction. Otherwise, you don't know if what you're doing is aligned with who you are, and no one around you knows who you are unless they've already known you for a decade. It might not be super clear to them. So those are some of the biggest mistakes I see right after a liquidity event.
Yeah, that makes a heck of a lot of sense, because you can mistake activity for progress, and in fact maybe regressing, if you will, just kind of throwing things out there without a strategic plan involved.
Right.
That's really, really interesting. Now you guys are involved. I think you rattled off a bunch of different industries, because a lot of this is basically, if you have a liquidity event, it's almost like starting a brand new business all over again, right?
Yeah, that's right. And what's common that people should always remember if they hear this as an investor, is that how you created your wealth and the skills you have, your distribution network, maybe your position in an industry, your relationships, you created your wealth for some very specific reasons, and you can continue to create more wealth. And sometimes the best defense is having a good offense, because you can be diversified. When the whole market goes down, you might go down with it. But the people who have a good offensive game can not only be smart enough to allocate after things have gone down, but also be making money even while the general, industry or economy is going down.
Let's talk about that for a second. What's kind of the buzz on the street in the ultra wealthy environment? I mean, what are people doing right now to make sure that if there is a correction, how are they protecting themselves?
Right. I think normally investors would be sitting on a little bit more cash, but because of inflation, which most people agree is around 12 to 15% inflation right now, right. They are putting more money to work than they normally would in an uncertain economy, because they just feel like maybe it's going to continue to be big inflation coming. There's more cryptocurrency investments going on right now, exponentially more than just 2 years ago with the ultra wealthy. I think that the other thing that is being discussed quite often now is just levels of debt they want to have across their portfolio and the terms of those debt and personal guarantees on debt. et cetera. And then also the longevity of investments they're getting into. If they can get their money back out of an operating business through structuring a gross revenue royalty structure, which we've done in about a dozen deals now, then that's of interest. Or if they can get in and out of a deal in 1 to 3 years, that is more appealing, so that every year they have some deal where capital's rolling off coming up. And that way, whatever year the economy sinks, they have just had a small liquidity event again and gotten some cash back or part of their cash back, and they aren't fully illiquid and don't have the cash to invest.
Got it. That's fascinating. Absolutely fascinating. Let's shift gears here a little bit and talk about it from the capital raise side. You got into this because you were raising capital. What was that industry for? Was there a particular niche you were focused on when you were raising capital?
Yeah, in college, I raised capital for a high-tech company from angel investors. And then after my MBA, I raised capital for some hedge funds and SMA products. So, that taught me a lot about what to do and not do. But, I found that with capital raising, figuring out what you're going to be best at raising capital for and honing that in to be very specific to who you are, but then also figuring out what investor is likely to say yes to you. And typically investors say yes to people who are local to the person raising capital or the team that's raising capital, local to the asset being purchased, so they can go see it easily and check it out, or there's been a familiarity with the industry. So they made their money in self-storage, they made their money in stem cells, and they're going to be more likely to understand it. At least if they're a doctor, they're going to understand stem cell therapy more so than a manufacturing guy, from Nebraska or something. So I think that it has to be familiarity with the industry, the team, or the person, or be local to the person or organization. And if you can line up all three of those trust curves, then a lot of people are going to come into your deals. But if you're going to investors who don't know you, aren't local to the deal, and they don't know the industry, they're probably never going to invest, because they're starting from ground zero.
Yeah, that's absolutely awesome. Good pieces of advice there. You guys realized that you could serve kind of both sides of this industry by bringing on capital raisers and people that need access to, the ultra family wealthies. I mean, it's a win-win. The ultra family wealthies need access to deals, and deals need access to capital. You said you maybe have 1,000 people or so on board. You said this earlier, and maybe if I misunderstood, correct me, but there's about 20 or so of those that could provide consistent deal flow. What does that mean?
Yeah, so we have 1,000 members who pay for charter membership to come to all of our conferences, like our Super Summit coming up. Then we have 3,000 plus investors who have registered with us and come to our events and webinars and conferences. Of those 3,000 investors, about 600 of them have signed a contract with me where I help them put their capital into deals and bring them deals. They don't just randomly bump into people at our conferences. I'll keep an eye out for them year round. And so those are the different levels we have. We have some VIP members that are charter members. They get some special access to investor databases, et cetera. But among all of our investors, there are about 20 investors who are the most active. Like we have a billionaire client that we have about $900 million in term sheets and JV commitments being closed right now. We have a very active $15 million net worth client that's done 6 deals with us, for example. But then on the deal flow side, we also think there's 20 or 30 really interesting investment opportunities among those 1,000 members who are all raising capital, meaning their offering is a very good match for some of our top investors. And then we're trying to connect the dots. At our next event in Fort Lauderdale, will have 100 one-on-one meetings going on between investors and attendees, in addition to the 800 people just attending the event and the 57 speakers on stage. There'll be a lot of follow-up and a lot of connections there live at the event. It's not just random.
Right. That's really interesting. What are things that your family offices are looking for right now that investors are presenting that they're saying yes to? And I know that's a broad question because, like you said, every family office has its own mandate. But
Right.
What are some things that you see are getting across the finish line that people are saying makes sense right now?
Yeah, some things would be self-storage, conversion from hotel into multifamily, healthcare, meaning medical practices and dental practices that have multiple locations and are doing multiple 7 figures a year in revenue. Gross revenue royalty deals where people are getting their money back off the top line revenue and not off of some dividend or crossing their fingers the company's going to sell in a decade to someone. And then deals that are local to someone real estate wise and are cash flowing in short duration, 1 to 3 year deals is kind of the stuff that's getting done most often. And then we've got a a big co-GP JV program with an institutional investor, and we've been signing several $300 million in equity term sheets for that. And essentially what we do is provide 97.5% of the equity for deals, and then the sponsor provides 2.5% of the equity. And then we grow a $1 billion portfolio together with them over a 3 to 5 year period. So we're doing that with our smallest group, had only 30 million in AUM when we met them, and now we've got them up to 150 million in AUM after 18 months. Another group had 300 million in AUM. They had operated for 4 years to get to 300 million, and now in the last 3 months they're at 700 million in AUM. So a few of those are taken off real quick, but we do small deals, operating business deals, real estate deals. So we're not specific only to one type of niche.
Right. No, yeah, I'm aware, not specific to one niche. I think that's fun because you get to see, I mean, you get to see it all, which I think would keep, certainly keep it interesting. I'm wondering, what are some deals maybe that you see are stuff that's being presented and it's just falling flat, and why do you think that's happening?
Yeah, I think that many times people write an essay long email to describe their deal, and that almost automatically kills it. Many people reach out and blanket emails to hundreds or thousands of people. They don't personalize it, and they don't add value first. And then they're just one email out of thousands in somebody's inbox. And that kind of kills the deal. Most people just will spend time getting an airplane ticket to come to a conference and then show up, and they can't describe what they're doing in one sentence. They could have just taken the time when you can't use your laptop and you're going up and down on the airplane to just draft out 30 versions of a one-liner that in a sentence tells an investor why it matters you exist on planet Earth compared to your 10,000 competitors. And if you're a hedge fund, then please God, don't say that you provide absolute returns and you do well whether the market goes up or down. And when it goes down, you do even better. Everyone says that. If you're a multifamily group, don't say you take B and C properties based on demographics and renovate them at 10K a door and provide the 17% IRR over 5 to 7 years. So like everybody says that. Like you need to say something that hits them between the eyes and says, wow, we've been looking for that. I didn't know that existed. That sounds like it's just for us, or that's so refreshing because it's structured so much better than how everybody else structures their deals. Those are some of the biggest problems. And many times when people go to their lawyers to set up a deal, they say, oh, well, how do I do this, lawyer? And then the lawyer says, oh, let me think. For $800 an hour, I can bill all these hours because it's how much it costs to do a fund, but I'll just use this template from this other fund I did. And they tell their client, oh, well, everybody does it this way. You should do it that way. It's the best practice. And it's great for the lawyer because they're doing something for the 90th time and charging their client $80,000. But you should do something that's not what everyone else is doing. You should do something better. So your structure is sweating for you, helping you close investors, and is superior in terms of alignment. So it's more performance fee based, or it feels like there's more transparency and rewards for you if you do well, but not charging a bunch of fees just for taking an investor's money.
Yeah, that's really interesting. Especially on the fee topic. I mean, we see, especially in real estate, I see a lot of deals that are just feed to death before and of course I don't participate in those, but before it ever gets back to the original investor. I mean, what are some standard fees that you see, especially with a family office? Say you have a single investor in a deal, if they're bringing, in this case, maybe 97 or 90, I've seen a lot of those terms, a 90-10 deal where it's, they're bringing most of the equity. I mean, what sort of fee structures make sense, say on a real estate deal like that, when you're dealing with somebody bringing a single investor, large check?
Yeah, many times it'll be minimal acquisition fee and management fee and more performance based. Sometimes an investor bringing a large check will demand a higher hurdle, but then give a more handsome, profit share after that hurdle. So they might want a 10 or a 12 pref for putting in a lot of money, and then will, have a more fair profit share for the sponsor because that higher pref, they're worried about protecting their capital. But in general, if you can keep it so that just your actual expenses are charged back and you're not making any profit on the acquisition fee or even the management fee, and you're transparent about that, then the investor is happy to have you rewarded handsomely on the back end. And if you get them a preferred return that's slightly better, so one example might be, let's say your actual expenses just get documented and you expect them to come in around 25 basis points on the acquisition fee side, and you show a spreadsheet of all your expenses, and your management fees are typically, industry standard at 1 or 2% maybe, but you document them and they're at 42 basis points on average, and you show the investor that, and you say, hey, but we'll give you a 9% preferred return, but then we want a 40% profit share. or something that's a little bit healthier, then that would be maybe one option, just to throw it out there.
Right. Yeah, that's great. That's great. And last question here before we wrap it up. If someone were to begin approaching family offices, what is a best practice as they begin reaching out? Like, what is something tangible that someone can do in that regard that really makes a good first impression?
Yeah. So one thing to realize is that there's family offices in every city and every industry. So if you're raising capital for a healthcare deal, figure out who the wealthy doctors are nationally who have a family office, figure out who the wealthy doctors are in your city, and show it to them first. If you're doing a litigation fund where you're funding, court cases and trial cases, then go to law firm partners who would feed you deal flow, add strategic insight, and invest faster than some random investor, and you have to teach them what litigation funding is. So go to those that are local to you as a family office, and go to those who made the money in your industry. And then figure out, how do you add value first? So when I first moved to Arizona, the first week here, I got my car serviced at a location, and they had a really cool business model. So I looked at their website, they had 20 locations. I emailed the two owners, and they replied to me the same day. And they had an exit recently for $100 million plus to Goldman Sachs, and they were building a second iteration of the platform in another state. And so when I approached them, it was just a simple one-line LinkedIn email that said, I run this ultra wealthy investor club, and I have an investment structure that will allow you to continue to expand without giving up equity each time you open a new location to your investors. And they wanted to hear about that, so it was a way to add value to them and not say, hey, can I come into your office to show you something that I can sell you, or so you can invest in my fund or something? Because that's asking to take something from them. I was offering to give something to them. And I think a lot of people get that wrong. Nobody is obligated to respond to your random emails about your fund or your deal, even if you're under some deadline. They get those emails hundreds of times a week sometimes if they're a well-known investor. So you have to start from a different mindset.
Right. I love that. I love that. Richard, last final few questions here for you. If you could help our listeners avoid one mistake, and we'll use this, usually this is a real estate related question, but one mistake as it relates to engaging, I think you maybe just answered this, but engaging with family offices, what would that mistake be and how would you avoid it?
Sure. One mistake is to be too high pressure or stressed out feeling, or rushed or disorganized. Family offices are long-term minded, and they're used to staying at the W or Four Seasons or Ritz-Carlton. They're used to having people be professional and polite and patient. And when you get thousands of inquiries a day, because one of my clients has 4,000 employees, one of my clients has 500 million net worth and 140 LLCs. A lot of these people are the busiest people on planet Earth. So for them, a week flies by like a day. And if you follow up 3 times in a week or twice in a day, and then, you just seem like kind of a stressed out, sweaty person trying to shake everyone's hand at the conference, they immediately will just think to themselves, I'm never talking to this person again. And so that's a big mistake. And I see it live at conferences when people are stressed out about raising capital. We also just sense it in people just following up way too often versus spacing out the communications a bit and making sure you respect their time.
Right. Yeah, absolutely. That's a great point. When it comes to investing in the world, what's one thing you're doing right now to make the world a better place?
I think one thing we're doing right is alignment and doing well to people while we're building our business, treating employees well, treating clients well, adding value, trying to add value to lots of people in a podcast like this, even though maybe only 2 people that listen to this will ever do business with us directly. I think it just helps people build their businesses by hearing these types of strategies that family offices use. And that's my selfish motivation for running the Family Office Club, is to put all these really smart family offices on stage, listen to their strategies, and then use them myself in my own business. And that keeps life interesting, because I have to go to all of my own conferences. So I don't want to be bored at my own events. And so that's generally how we're doing it. And then we also have a new platform that we're building out called investorresidences.com. And every time we buy a house for that network of houses that ultra wealthy investors or just high net worth investors can stay at, and we short-term rental them out when they're not staying there, we're going to be building a house for our orphans and children that don't have houses in other countries. So it'd be like, we're going to buy a house, we build a house, and we're doing that in partnership with Jeff Hoffman, who's one of the founding investors of Priceline.com and Booking.com, and trying to formalize that program with him right now. So that's one thing that we're excited about. And then if anyone would just like to check us out, if you're a doctor or a dentist or a passive investor, you can come to our Family Office Super Summit for free. And you're welcome to come as our guest. If you are raising capital for something, or you have a fund, or you syndicate deals, then it's a $99 first month trial to attend. But the food, catering, and bill alone is $170 a head for this conference. So we're losing money for you to come check us out. And for a decade, we have guaranteed people, if you don't like the chicken, if you don't like the scrambled eggs or the speakers or anything at our conference, we'll give you all your money back that you spent on coming. And at our last 840 person event at the Ritz-Carlton, we had one person ask for a refund. So who knows, you might not like the eggs or the speakers or me or something at the event, but we make it like ridiculously low risk, because most people, once they come, they love it, and then they're part of the community and they grow with us, et cetera. So that's the Family Office Super Summit. It's on December 13th in Fort Lauderdale, and we're going to have 800 people there and 57 speakers on stage in one day, including a couple of billionaires and 4 heads of publicly traded companies and a shark from Shark Tank. And if anyone wants to learn more, it's just at familyoffices.com/super.
Richard, thank you so much for your time today. This was great. I do appreciate it, and look forward to seeing you here in Fort Lauderdale in a couple of weeks.
Awesome. Thanks, Sam.
Hey, thanks for listening to the How to Scale Commercial Real Estate podcast. If you can do me a favor and subscribe and leave us a review on Apple Podcasts, Spotify, Google Podcasts, whatever platform it is you use to listen, if you can do that for us, that would be a fantastic help to the show. It helps us both attract new listeners as well as rank higher on those directories. So appreciate you listening. Thanks so much, and hope to catch you on the next episode.